Hey, I'm Jason, and this is Supply and Demand Daily, where I tell you what we learned about the economy today. I have a couple of data releases to go through with you today. So the first thing that we're going to talk about is the Job Openings and Labor Turnover Survey, or the what is it called? The acronym for that is JOLTS. So Job Openings and Labor Turnover Survey, JOLTS. So that was not all that interesting, but I pulled some details out of it that were a little bit more interesting, and so I'm going to briefly cover those. We're going to talk about manufacturing, the state of the manufacturing index in the U.S. by the Institute for Supply Chain Management's Manufacturing Index. You'll notice that there are a lot of manufacturing indices. I can think of just three off the top of my head. The one that I just mentioned. There's the one that is recorded by the Philadelphia Federal Reserve for the sort of Rust Belt area, and there's also the Chicago Federal Reserve's manufacturing index as well. So at least I think it's the Chicago Federal Reserve. I might have to circle back on that. Jen Psaki, if you know who that is, totally ruined the phrase circle back. It was a great phrase, and then she ruined it. But anyway, so why the motor vehicles bubble is incredible and terrifying. That's the third thing I'm going to talk about. The motor vehicles bubble, the used car bubble that we're currently in, which may not actually be a bubble. It seems to be quite well explained by fundamentals. Actually, it'd be good to do a video on bubbles in general, but a lot of people are referring to it as a bubble, and I'm going to go through why that is sort of extra crazy, right? Through three different lenses. So those things and more, actually not more, just those things here that I have for you. So the first thing, the JOLTS survey, what did we see in April? So this is lagged by 2 months, unfortunately. So we're sitting here in June and we're looking at April. So what I wanted to share is the industries that are increasing in job openings and decreasing in job openings. And on the lower end, we have healthcare and assistance that led the pack as far as decreasing job openings. We have retail trade and we have accommodation and food services. So we saw most of the decreases in job openings concentrated in the services sector. And then you'll find this interesting. On the other side, we had increases in job openings for transportation, warehousing, and utilities. Okay, so a make stuff group of industries, right? Non-durables manufacturing, literally a make stuff industry. How do you get manufacturing without making stuff? And then we had durables manufacturing increasing as well, although not by as much as there were losses to the non-expanding sectors as far as job openings go, at least. And of course, there was actually a net loss to the number of job openings last month, or not last month. In March, there were 11.4 million job openings, and then in April, there were 11 million total. Right, so a drop of about 400,000, and that's why when you add all of these together, you get a negative number. So we're at net less job openings, and the current ratio of job openings to people searching for work, I think, is around 5 or 6, something like that right now. I'll have to cover that when the non-farm payrolls come out on Friday. We're going to look at that is the report that actually details what the unemployment rate is, and that data will be updated as of May, and that comes out this Friday. So we will definitely be looking at that again. Be looking at some of this information again in light of the non-farm payroll report. But now I want to get into the ISM Manufacturing Index. And the first thing that I want to point out for you is this white dashed line here. And what that line means, that is the line that signifies that any number above that line means that manufacturing is in an expansion phase, right? Economic expansion, more goods and services, or in this case, goods, coming off the production line to be consumed by you and I, all right? And then everything below that line signifies contraction, okay? And then the yellow line is the percentage of firms, essentially, when you sort of whittle away all the details of the calculations, you can think of that yellow line as the percentage of firms who are reporting growth, or they report more positive details about their businesses than negative ones, okay? So what I have, and then the blue dashed line here is the level that was reported for April. So we're still kind of riding down on a downtrend here, going back to the middle of 2021. You can see a similar pattern in most of the manufacturing indices that you look at, whether it's the the Empire State, which is about New York, the Philly Fed Manufacturing Index, all of these different things. You can kind of see the same fluctuations, especially this dip here with the manufacturing recession of 2014 and 2015. This particular measure, even though there are other indices that are actually in contraction territory, I think the New York State Manufacturing Index is one of those. This particular one is still quite, considerably above contraction territory, so they're not all moving in tandem together. And this is again from the Institute for Supply Management, rather. And then I have some other details here. So it looked like in most of the areas that they asked questions about in this manufacturing survey, there was actually growth reported. And in the case of inventories, it was reported that the inventory level is too low, and that's an ongoing theme in the post-COVID environment. There's a lot of shortage of inventory out there in the business world. But I did want to show that employment seems to be the first thing that is actually dropped below the contraction line, and so this will be interesting to monitor as time goes on. Unemployment is just below that contraction line. So they kind of disagree. So for the overall index, the line of contraction is about 48%, but then for these subcategories, it's 50. So something to think about there. But the employment index is definitely dropped for the last couple of months and is now below the contraction line. And I just showed a brief, 3-month chart to show that. So a little detail to pick out there. And now the next thing that I want to talk about are just some interesting little snippets of these survey reports. So from April, the biggest concerns in that month were supply chains and input prices. So shortages of goods that need to be used to make other goods, right? So supply chains and input prices, the increase in the price of those inputs. So the inputs for a hat, let's say are some canvas and some cardboard for the bill and some metal for the buckle, maybe. And then in May, the manufacturers in this index, they reported the same thing. The biggest concerns were supply chain difficulties and input prices. In April, it was reported that they were most concerned about energy market instability, and that particular detail, it was not mentioned in the comments for this report. And when these reports are released, you don't get to see just raw data, raw details from all of these different respondents. They are picked by the ISM, and it is chosen by the editors what they're going to include in the report. And one thing that I did find interesting was in March, they reported the positive to negative sentiment ratio in terms of comments, both positive and negative. So you can take a ratio between how many comments are positive from these managers and how many are negative, and then take the ratio between the two. And in March, that was a positive to negative comment ratio of 6 to 1, right? So 6 positive for every 1, and they don't even say negative necessarily, but positive to cautious, right? This is the word that they use. And then in April, that dropped to 3 to 1, and in May, right? In May, we are talking about May here, right? Yeah, we're talking about May. Yes, we are talking about May. I do apologize if I mentioned April previously. Not sure where all I used that word. So anyway, we had 3 to 1 in April, and then it wasn't reported for May. So honestly, I'm not sure what to infer from that. I don't know if there was such a big improvement that this, maybe downward trend sort of did not continue, it stopped, or if it was so bad, maybe there was an overtaking between the positives and the negatives, and now there's a ratio that is skewed to the negative side. I don't know. It just wasn't mentioned. So that's something that I'm going to look out for in the June report for sure. And then the next thing, we had some comments in April that I thought were interesting. This is the survey that came out last month, right? So, quote, Tier 2 supplier shutdowns in Shanghai are causing a ripple effect for our suppliers in other parts of China. Long delays at ports, including in the U.S., are still providing supply challenges. Inflation is out of control. Food costs and therefore freight costs are leading the upward cycle. At some point, the economy must give way. It will be tough to have real growth with such pressure on costs. Despite the issues and poor outlook, business remains brisk, and that came from a respondent in the chemicals industry. And then another comment that I found interesting, due to electronic component supply issues, production output has been lower than normal. Backlog is growing due to the supply chain issues. New order sales are steady, except international orders are lower, and that came from fabricated metal products. So a drop in demand from overseas, which does definitely correspond to, the economy is definitely shrinking in China, whether you attribute all of that to lockdowns or not. And the indicators out of Europe are definitely that the demand is slowing in those countries as well. And then the same thing is happening in South Asia countries. For instance, Sri Lanka is in the middle of a financial crisis right now, something that I will probably do a little bit of detail on here in the next couple of weeks. So in May, there was a little bit of a change of tone, but some similar themes. Quote, suppliers are seeing a light at the end of the tunnel for restoration of semiconductor component supply. Second quarter and Q3 supply appears to be loosening. So input costs, particularly grain, oil, dairy, and protein, are rising faster than can be passed along at retail and food service with no relief in sight. That's from the food, beverage, and tobacco products industry. And then a differing opinion on semiconductors. So this is why I include both of these remarks. The challenge with semiconductors hasn't softened. The situation is worsening due to Chinese COVID-19 lockdowns, and that's from the transportation equipment sector, which might have something to do with automobiles. Okay, probably has something to do with automobiles. So we have two different sectors who are reporting two different things when it comes to semiconductors. And so it just kind of shows that everybody experiences these different supply chain issues, a little bit unequally. So, all right, car prices, what's going on? So this is from Car Gurus, which if you've ever used Car Gurus to shop for a car, it's a very handy app and website. But this is a price index that goes all the way back to 2010. So August of 2010 is the first month that this data is available. And what I wanted to point out is just how crazy the increase in used car prices have been. So their weighted average goes from over, under 22,000, okay, in 2019 going into 2020, all the way up to above 30,000 in 2022. Holy crap. So a 43% increase from January 2020 to April 2022. That is huge. And then we see a similar thing in the Consumer Price Index as reported by the Bureau of Labor Statistics, okay? So at the beginning of this era, so August 2010, we're sitting at an index level of about 45, and then it actually goes down. So the trend for the 2010s was actually downward, going all the way into 2020, and then in late 2020 it starts to pop, and then it pops again, and then it pops again, and we're at 205, 215. I mean, just insane, as signified by the red arrow here. And we would expect this out of new cars, but not necessarily used cars, because when it comes to used cars, we expect the price elasticity, which is, you can think of as the relative willingness of people to buy things once the prices go up. So there's certain products for which if the price goes up by even just a little bit, you're not going to buy as much. And then there's products where if the price goes up by a lot, then you're still going to pay for it. And one of the best examples of those in economics is cigarettes, because people are addicted to nicotine. And so even if the government adds a pretty hefty tax to cigarettes, or if the tobacco companies for whatever reason raise their prices, or there's a huge virus that wipes out half of the tobacco harvest for the year, then the smokers are still going to pay those prices for their products, and they will take money from other parts of their budget in order to do so. So that's elasticity, and you would expect more of that out of the used car market than the new car market, but the price increases in the new car market definitely have not followed that crazy trend of used cars, and a lot of that is probably just because new cars are not available. And that goes back to the semiconductor shortage, which I mentioned on the ISM index, report just a couple minutes ago. But then, why is this so different, right? Why am I even talking about this? Well, what makes the used car bubble, remains to be seen if it actually is, what makes the used car bubble so interesting is that when we look at housing, there's this big, huge swarm of demand that jumps on the market, and we have more transactions than ever before. Okay, we have new home sales that break relative records. I don't think home sales went up quite as much in the last couple of years as they did, say, between 2003 and 2006, but they went up quite a lot, and we had all of this money chasing this small number of homes, this small supply of homes, and we had all of this demand, a lot of it coming from the central bank buying mortgage-backed securities, which dumps liquidity directly, and by liquidity I just mean money, right? Dumps money directly into the housing market, and so that was a big driver of the demand that we saw in the housing market, which led to these crazy prices that we see now, like the same house increasing in value by 100% over the course of a couple years, things like that, which has actually happened in major metropolitan areas, not on average, but if you look at, individual instances. Okay, so, but what makes the used vehicle market so interesting, what makes this little particular bubble so interesting is that auto sales have not done that at all. So auto sales are no higher currently sitting here in 2022 with these huge prices. Auto sales are actually not any higher now than they were in 2015, 2016. Okay. And so they definitely spiked above here in early 2020, or looks like late 2020 or early 2021. But they've been actually trending down ever since then. So it's just crazy that most of this response. So the blue line here I have is total sales as reported by the Bureau of Economic Analysis, and then the gray bars back here are the inventory to sales ratio, which tells you something about the scarcity of available cars, right? And so what this inventory to sales ratio shows is that here in April 2022. We have less than half a car, right? Less than half a car available on the lot for every one person who wants to buy a car. Or for every one sale, there's half a car sitting on the lot in inventory, which is absolutely crazy. Numbers we haven't seen before, but this is entirely a supply-driven phenomenon, which is what makes this this used car bubble so interesting. And so I wanted to point that out. There will be some new data on motor vehicle sales reported by the Bureau of Economic Analysis here, I believe, later on in the month. So that'll be interesting to see. But yeah, I mean, the fundamentals here in terms of the price, what's driving it, are really all in the supply. And a lot of it comes back to these base commodities. Aluminum has gotten expensive and semiconductors have gotten unavailable and all of this different stuff. But certainly a way that everybody is paying for the economic shutdowns that happened over the course of the COVID-19 pandemic. So just wanted to share that because I found it very interesting and unique. You usually don't see these kinds of phenomenon in different markets, but it's definitely happening in used cars right now. That's all I have for you today. I'll be back tomorrow with I didn't post a slide for that, so you'll just have to wait and see, all right? So I hope to see you back here tomorrow. That would be Thursday, June 2nd, 2022 for Supply and Demand Daily, and I'll catch you later. Thank you very much.